everybody. Margaret Weatherford here, your local real estate broker with eXp Realty. I wanted to come to you today to talk about home equity lines of credit, or more commonly known as HELOCs. I have some clients who have recently discovered that they have a great amount of equity built into their property, and they are interested in taking some of that equity or some of that cash out and using it for a purpose such as adding a deck to the back of the house or putting in a pool, different types of home improvements that they've noticed now that they've lived in the home for a few years that they would like to do. So I wanted to share with you a very basic video of what a home equity line of credit is and how it may be able to help you. Again, a home equity line of credit is a type of second mortgage, and it allows homeowners to borrow money against the equity that they have in their home and receive the money as a line of credit. Borrowers can use HELOC funds for a variety of purposes. So you can do home improvements, you can use it for paying off student debt, you could consolidate high interest credit cards, anything you want. You can even use a home equity line of credit to purchase another property. And we'll talk about that opportunity in a separate video. But the qualifications for HELOCs, of course, you have to have reliable income. You have to have good credit. So I would say maybe mid 600s, low 700s. Speak to your local lender about that. And the qualifying amount of equity in your home, so you should have about 15 to 20% equity in order to be able to access some of these funds. And of course, the lender is going to want to see, just like when you buy a house, that you've had a responsible payment history and that you have a low debt to income ratio. So these are all requirements for being able to obtain the home equity line of credit. How are you going to pay it back? Well, there's a draw period, which is actually when the line of credit is open and available for use. So during this period, you'll be allowed to borrow from your line of credit as needed, making minimum payments or possibly interest-only payments. If you reach your limit, you'll have to pay off of some of what you owe before you can continue borrowing. And then the second phase is called a repayment period. So once you reach the end of your draw period, you won't have any more access to these HELOC funds, and you're going to have to start making full monthly mortgage payments. Remember, because it is a second mortgage, full monthly mortgage payments on the principal and interest. So for example, you may have a HELOC set up where it's a 30-year HELOC, a 10-year draw period, and a 20-year repayment period. In order to actually know what the property is worth, the lender will have an appraisal done. So there will be a home appraisal, whether it's a desk appraisal or an appraiser actually comes out to your property to see what the current market value is of the property before they issue the home equity line of credit. And of course, there will be a title search and attorney's fees that go along with this. Your home will be used as collateral. So of course, anytime you take on debt, especially debt that's tied to your home, there are some risks. And if you're unable to make the payments on the HELOC, you could potentially end up losing your home since it acts as collateral for the loan. Third, somewhat of a disadvantage would be your rates and payments may increase. So it's not a fixed interest rate. The HELOC is based on market fluctuation. So if your rate goes up during if your rate goes up or your draw period ends, you could potentially be in kind of a sticky situation. But some things that are great about a HELOC. So again, you're consolidating debt potentially at a low interest rate. The money can be used for anything. It does give you access to large sums of cash, and you can borrow as much as you need. And of course, the interest on the HELOC may be tax deductible if you use it for home improvements, but talk to your CPA about that. So how do you calculate how much money you might be able to access through your HELOC? Well, you're going to take your home's current market value, which speak to your local real estate broker to find out what the property is currently worth. And you're going to multiply that by the lender's loan to value ratio, or how much you originally borrowed on the property. So let's say, for example, you bought your home for $250,000 and you put 20% down. So the LTV would be 200,000 minus 180,000, which is what you currently owe. So your maximum HELOC potential is a credit limit up to $20,000. So again, you take what your home is currently worth and you multiply that by the loan to value number. And then from that number, you subtract what you currently owe on the property. And that's going to give you a rough estimate of how much credit you're going to be able to access. Of course, you do want to talk to your local lender and your local real estate professional to get a better idea of all of this. But if you have any questions or if you want to get connected in the Southeast, so North Carolina, South Carolina, or Georgia, please give us a call. We're happy to help. And we look forward to showing you more ways that you can use the equity in your home to make smart decisions.